Hi, welcome to the Genus quarterly video. I'm Leslie Cliff. I'm here with our Chief Investment Officer, Wayne Michelle, and we want to bring you up to date on what happened in the first quarter of 2019, which was a very happy quarter. The stock markets around the world up over 10%, interest rates down, all kinds of good things happening. How did you feel about the quarter?
Well, a very strong reversal from Q4 of last year. And what's driving the big reversal is the fact that the Fed paused. And there was concerns that the Fed was hiking up rates too fast and we're ahead of the market. And the Fed, Powell, in a very contrite way, said they're back in line with the market effectively. So that the market forgave them and rallied hard on that kind of news.
What else is happening in the quarter in terms of the types of stocks that are doing well, for example? Well,
it's been a quarter where a lot of the stocks that did poorly last year came back strong this year. It was a big reversal quarter. Some of the themes that actually worked were companies that had declining earnings and low cash flow. And so it's been a quarter where companies with strong fundamentals didn't do that well.
Right.
And we've seen net flows. There's been still flows out of stocks into bonds. I think a lot of the big players, institutional players, are still selling stocks and going to bonds as stocks have done so well over the past.
And those are really retail, even though they're big. It's a flow through from Fidelity and so on of retail clients selling.
No, I think it would be more institutional than retail. I think retail are they tend to chase the markets up, but I think it's bigger players that are basically, have strategies and they're unwinding them and going into bonds.
Right. And what about what's happening economically through the quarter? I mean, we still have low global growth, low money supply growth.
Where the market...
Things that aren't consistent with the market being up over 10%.
We tend to look at what's happening in reality in terms of, is the economy growing? Is the Purchasing Manager Index growing? Is the money supply growing? What's the shape of the yield curve and other different risk metrics? And those really haven't turned around that much in Q1. We've seen, I think, a lot of anticipation that we're going to have easy money through the course of this year, but we're not sure of that yet. Until we see the evidence of that, we're not going to change our stance. We're defensive. I said earlier on we were going to trade this year between 2,900 and 2,300. We've gone through that today.
Well, if you get out the video from last week, you actually said 2,800.
I thought it was 2,900.
Yeah, but you go look at the video.
Okay.
But the point is we're at the top of the range.
We're at the top of the range, and we're defensively positioned right now, and we like that right now.
What's interesting to me is so many events are out there that have not been concluded. They're still out there. China trade, Brexit, so on. The Canadian election, upcoming federal election, the Alberta election. The market doesn't care about any of these things until they know how it's going to impact the market. But the market seems to be pretty benign, assuming good things are going to happen.
Yeah, that's my read as well, that basically there's a lot of things that can go wrong here. It's assuming we're going to get a trade deal with China. That's still some ways away. And I think the Iran issue is oil embargo is going to maybe complicate that relationship as well. So, and there's the whole, the U.S. is turning up the notch, turning up the heat on Iran. You could have a closure in the Strait of Hormuz, which could cause an oil disruption.
And didn't China just say they're going to ignore Trump and buy oil from Iran anyways?
That's going to probably have an impact on the negotiations then.
Right,
too.
it's negotiated.
The bottom line, there's a lot of things that can go bump the night here. Yeah. And we still have to see how the whole, Mueller thing finishes up with, in terms of will that cause any disruptions with the administration as well. So it's, the market's assuming a lot of good things are going to happen and that the money's going to flow this year. And we haven't seen the material, that hasn't materialized in our models yet, at least.
Right. So we went defensive spring, summer of 2018. And by defensive, I mean we've sold, if you were a balanced account that normally would have 60% equities, you went from 65% equities in March to 60% equities. So you sold about 6% equities, which is why you had a good capital gain and you're paying taxes this week. Because we sold.
We also rotated to more defensive stocks as well through the course of the year as well, through our dividend strategy.
So in the fourth quarter, we were rewarded for that. And in the first quarter, clients are up nicely. They're up over 5%. They'll get their statements. But stock markets are up over 10%. And we're still defensive. So are you still feeling good about our position in our clients?
Yes, we've been during a period when, as I mentioned, a lot of the junk rallied. It was a big reversal trade in this Q1, anticipating, I think, more Fed easing. And we focused on fundamentals like free cash flow and forward cash flow, and we also have momentum in places like Canada where it pays to have momentum. And both those themes just haven't worked for the past 6-7 months. So we think these things will come around at some point, and fundamentals always do come around. And so we're waiting for more of a normalcy in this market once we've hit this peak here.
Yeah, and I don't think any of our clients are going to be complaining about a 5% return in the quarter, even though the markets have been really very good. So Wayne, we have a big position in global investments in all the portfolios, but we live in Canada and we still have a good position in Canada, obviously. Tell us more about what this election in Alberta really means and the falling from grace that Trudeau is suffering. What might be the economic impact of these things?
Well, a couple of things. Number one, I think with Kenny winning the premiership in Alberta, you're going to see the rhetoric crank way up. And he's going to get aggressive. He's going to go after the environmentalists. He's going to go after BC and everything else. You'll see more of a ganging up. There's more provinces now that are conservative. You'll see them ganging up on Trudeau and giving him lots of opposition. I think you might even see ultimately, if they don't get their way in Alberta, it'd be a threat of separatism.
Right. I've always said never worry about Quebec leaving. Worry about Alberta leaving.
And if they can't pump their oil through Canada, they're going to pump it through the U.S. maybe. So that's a risk to Canada, I think, longer term.
And what does it mean for portfolios? Like Canadian dollar goes down, the bank stocks go down, obviously oil stocks in jeopardy. But where do we get hurt?
The Canadian dollar would go down. You'd see risk premium on our stocks as well go up. Probably impact the banks, I would think, longer term. That's a risk out there. I'm not saying it's going to happen. And I think it sounds like the Trudeau government wants to get this the pipeline thing settled sooner than later for the Trans Mountain Pipeline, probably this summer prior to the election.
Right.
So that
might be a good thing.
That could be a good thing as well. And Canadian banks are strong and doing well as usual. But they are susceptible to a downturn in our economy.
Right, and banks are very exposed to oil in Canada, and they're also very exposed to residential real estate. And Toronto, Vancouver are suffering from declining property values, and we don't know where the bottom is for that. Does that represent a big risk for our banks? Because they all have international operations too. They're not just Canadian banks.
I think the big risk there's not so much the banks, but the currency. I think if we have any kind of real estate problems here that really become manifest, you'll see rates go down even lower than they are right now, and it'll probably drag the Canadian dollar down, which will make Canada real estate more attractive to foreign buyers too.
And let owners refinance their mortgages at lower rates.
Right.
So self-correcting.
Yeah. And that could maybe hurt banks somewhat from a profitability perspective. If the curve gets very flat and rates are very low, it hurts them as well. But I think the big victim would be the Canadian dollar. Right now we're neutral in the Canadian dollar. I'm saying that is a risk there to the Canadian dollar if some of these things come true. But we're hoping for a global rebound in the economy into the end of this year. And if that happens, that's usually good for oil. It's good for global trade. It's usually good for Canada. So that could be a hope.
Right. But we're defensive right now.
Yes, that's correct.
So it's been a happy quarter. We're nervously happy. And please call your portfolio managers, and we'll see you next time.